Hi, in this video, I'll share with you 2 stocks and 1 ETF that offer a great buying opportunity this month, right about now. Now, the markets have been very high throughout most of July and in August now during the first week. And so bargains seem to be very hard to find, but actually if you look, there are opportunities to invest even now. So in this video, I'll share with you 3 stocks that present a great buying opportunity right now. Hi, welcome to another video. My name is Molly, and on this channel, I share my investment journey plus other personal finance lessons around things like saving money, budgeting, investing, taxes, and so on. I am a dividend investor. I have been sharing with you the progress of my dividend portfolio on this channel, and that portfolio is on Questrade. If you're looking to open up a new investment account on Questrade, use my referral code down in the description section of this video so you can get a $50 bonus that you can use to put towards your investments. Please remember that I may benefit too. Now let's look at the stocks. The first stock is Procter Gamble, ticker symbol PG. PG is a stock in the consumer staples sector, so a defensive stock because it is a non-cyclical stock, meaning that its products are always in demand. We all use its products. If you look around your house, chances are you'll find something from P&G in your house. Everything from cleaning detergents like Tide, Bounce, Gain, if you have kids, Pampers, Dawn, Febreze, Gillette, and so on. P&G is a great dividend stock because it's a large, well-established company. In fact, it is a dividend king, meaning that it has consistently raised or grown its dividends for at least 50 years. That's a very exclusive club of stocks. Unfortunately, the stock is down about 10% over the last 12 months and about 9% down year to date. It is trading in the lower 150s, which is down from its 52-week high of about $180. P&G has a decent payout ratio of about 63%, meaning that it has room to continue growing its dividends way into the future. Its dividends are safe. A dividend payout ratio or a payout ratio is simply the percentage of a company's net profits or net income that it pays out to its shareholders in the form of dividends. Now, a shareholder is simply somebody who holds stocks in any publicly listed company. So if you own shares of P&G, Procter Gamble, then you're a shareholder of Procter Gamble. The stock pays a decent dividend of $4.23 per share annually. So if you had 250 shares of P&G, you would receive over $1,000 in dividend income annually, passive income. So that is P&G. Right now may be a good time to buy, also because analysts' average target price for the stock is at least $170. And so it's trading in the low 150s, now presents a good opportunity to invest in P&G. Full disclosure, I own the stock. Now, if you enjoy content like this, please consider liking this video and subscribing to my channel. It helps the channel grow. It also encourages me to continue making these videos. Don't forget to share with family and friends and hit on the bell icon so that you're notified every time I post a new video. Let's look at the next stock. The second stock that presents a great buying opportunity right now is Visa. Visa is one of those rare stocks that offers both a great capital appreciation and fantastic dividend growth opportunity. Visa is the largest payment processing network in the world based on the volume of transactions it processes and the locations in which it is accepted, and it continues to innovate. Other credit cards like MasterCard and American Express are considered small competitors based on the volume of transactions that Visa processes. Visa has a large market capitalization of about $650 billion TTM, and according to analysts at companies like Motley Fool, the projection is that it will hit $1 trillion market cap in less than 10 years. Now, after returning an average of over 30% over the last 12 months, the stock is currently down about 8%, and it's trading in the low 330s, down from its 52-week high of $375. In fact, based on analysts' average target price, it should be trading at over $390. So now, in the low 330s, it presents a great opportunity if you're shopping for a quality stock. It is a quality stock both in terms of profitability and dividend growth. Visa is a cash generating machine due to its very low operating costs and has a gross margin of over 52% and free cash flow of over $18 billion over its most recent quarter. Not many companies can say that. Now, the gross margin is basically the percentage of a company's income that it gets to keep after covering all its operating costs. Free cash flow tells you of a company's ability to meet its short-term obligations without resorting to borrowing, being able to pay your operating bills, meet debt obligations as they come due. Free cash flow tells you of a company's financial health. A company that has to resort to borrowing in order to meet short-term commitments is not a very financially healthy company. Now, while Visa has a low yield of 0.70%, I mostly hold Visa for growth, and I know that a lot of investors hold Visa for growth, but also for future dividend growth. It has a very low payout ratio of about 20%, which means that it will continue to grow its dividends at a very fast pace or at double digits long into the future with such a low payout ratio. So that is Visa. Now, I have Visa in my portfolio, so please do not listen to some random person on YouTube. Do some further research for yourself, but I think the stock presents a great buying opportunity right now. Have I added some to my portfolio? Yes, I did. So that's Visa. The third stock is SPLG, and that's an ETF, an exchange-traded fund. SPLG tracks the S&P 500 index. So the S&P 500 is an index that tracks the 500 largest companies or most successful companies in the US. Now, unlike the first two Nvidia stocks, SPLG is not down. In fact, it's close to its all-time high at this point, but stick with me and I'll explain why now might be a good time to get into this ETF. SPLG is a quality ETF and is issued by State Street, the same company that issues SPY. SPY, of course, is an S&P 500 ETF. It's an OG of all ETFs and was conceived or was established in 1993. So here are the two reasons why you should consider investing in SPLG. Full disclosure, I own the same stock, but here are my rationale for investing in SPLG. The S&P 500 tracks the 500 most successful companies in the US, and that index is currently dominated by tech stocks. In fact, over 30% of the S&P 500 is taken up by technology sector stocks. And of the top 10 companies in the S&P 500, only one of them is a non-tech stock, and that is Berkshire Hathaway, the company of Warren Buffett. What's more, we are in a new gold rush era led by AI, and technology companies are the key drivers of this new era. Now, understanding that there are so many companies competing for dominance in the AI space and picking individual stocks can be very tricky, the best hope for an investor who is looking to be hands-free, maintain minimal risk, and yet benefit from growth in AI stocks is to invest in an S&P 500 ETF. Now, someone will ask, why not simply buy a tech-focused ETF like VGT or QQQ? Fair question. The issue with buying a sector-specific ETF is that you dilute the benefit of diversification. While the S&P 500 is more diversified than a single sector ETF, it's a broad market ETF. And although the S&P 500 is currently dominated by technology stocks, they only represent less than 35% of the ETF. The other 65% of the S&P 500 are stocks from other sectors. So by investing in an S&P 500 ETF, you remain broadly diversified while enjoying the benefits of growth or advances in technology, but you also enjoy the diversification of the other 65% of the S&P 500. The second argument for SPLG is cost related. Now, I understand that not all ETFs are created equal. SPLG was largely created to allow investors who could not afford the high sticker price for SPY to also benefit from the S&P 500, but by starting at a lower price point. SPY trades for over $630 a share. SPLG currently trades for about $75 a share, but I don't think that will be for long. Other S&P 500 ETFs like VOO and IVV also trade close to $600 or greater. Now, the performance of these 4 ETFs, SPLG, VOO, SPY, and IVV, are all the same. Because here, let's have a look at this. So, as you can see, year-to-date return for all 4 ETFs is about 8%, and returns over the last 12 months is about 20% for all 4 ETFs that track the S&P 500. So based on the difference in price, SPLG offers a great opportunity for investors, especially beginner investors, to invest in the S&P 500 without waiting until you have $600 to buy a single share of either SPY or VOO or IVV, especially if you invest on a brokerage that does not offer fractional shares. Because that was me in the fall of 2024. Questrade did not start to offer fractional shares until the spring of 2025, and because I did not want to wait until I could accumulate $500 in order to buy a single share of VOO or SPY or IVV, I found that SPLG offered a great opportunity to invest in the S&P 500 without delay and getting my money quickly into the market. Now, given the same performance across all these 4 ETFs, the difference in price, in my estimation, in my judgment, comes from the total assets under management for each of these ETFs. So while SPLG has total net assets of about $80 billion at the time of this recording, SPY has total net assets of over $650 billion. IVV, which is a BlackRock S&P 500 ETF of about $640 billion, and VOO, a Vanguard S&P 500 ETF, over $1.5 trillion. Now, here's another observation. As a newer investor in SPLG, I started investing in this ETF in the fall of 2024. I know that the ETF is starting to be looked at more favorably by more investors because the average volume traded on a daily basis is now nearly 9 million shares. When I first started investing in this position, the stock volume traded wasn't this high. The other thing, of course, is that the total net assets under SPLG has grown from less than $60 billion when I first invested in it in 2024 to now nearly $80 billion. So while SPLG may seem expensive right now, close to its all-time high at $75 a piece, I have no doubt that it will be growing and getting up to $100 in a very short time. So today might present the best time to start investing in this stock, especially if you're looking to invest for the long term. And for added advantage, SPLG has a really low expense ratio of 0.02%, so it will cost you about 20 cents for every $1,000 you invest in this ETF, while SPY has an expense ratio of 0.09%, so it costs you about 90 cents for every $1,000 you invest in SPY. For IVV and VOO, both have an expense ratio of 0.03%. So that's SPLG, a quality S&P 500 ETF that is at a great price point for investors who are looking to take advantage of the future growth in technology stocks, the exponential growth in AI over the next 5 to 10 years without sacrificing and paying $600 a piece, and buy the performance that is about to get unleashed with the growth in AI stocks and remain very well diversified. Anyway, I hope you enjoyed the video and found it helpful. If you did, please consider liking and subscribing, share with family and friends. I'll see you in the next one.